Hey investors, welcome back. So today I want to talk about oil stocks. And I want to talk about oil stocks because I think they represent one of the last opportunities to make money before we fall into a recession. I almost recommended oil stocks in my 2 videos ago, not my last one, but the video before that. I almost recommended oil stocks, but then the Fed came out with their 75 basis point rate hike and started talking about at the July meeting another 75 basis point rate hike. And that led to oil stocks falling based on recession fears. So I was hesitant to put that in that video. I actually pulled that segment out of that video. But with oil stocks rebounding today and some of those recession fears subsiding, I want to revisit oil stocks and I want to talk to you about them today. So we have oil stocks rebounding and then also an interesting upgrade on ZOM stock, XOM, Exxon Mobil, and we'll talk about what some other investment options are out there. There's honestly not very many options as we stare a recession square in the face. We talked about that in my last video where a recession is definitely on the table and could be coming as early as this year. We've had Michael Burry and some other banks, actually just one bank in particular so far, calling for a recession potentially coming as early as this year, 2022. So let's go ahead and jump into it. First off, I want to give you guys an update on what's happened since Friday and then what's happened today. Give you just an overview of the oil market, oil stocks in general. Found this article on Motley Fool. It's free. And I think the author did a really good job of summing up what's going on with oil stocks. Why Exxon, Chevron, and Phillips 66 shares plunged on Friday. Here's what happened, guys, on Friday. Shares of Exxon Mobil, Chevron, and Phillips 66 plunged on Friday, down 5.6%, 5.6%, and 5.7%, respectively. As of 1:43 p.m., the sector was an outlier as the broader indexes were rallying at that time. As is usually the case when there are big moves across multiple large oil stocks or any stock in the same sector, there wasn't any material news out of these 3 companies at the individual level. Rather, the synchronous move had to do with macroeconomic concerns. Specifically, oil prices plunged today, down nearly 7% as oil traders appeared to begin pricing in a potential recession. Earlier this week, the Federal Reserve raised the federal funds rate by 75 basis points, the most aggressive single sessioning tightening since 1994, in an effort to bring down inflation. Unfortunately, with inflation beginning to metastasize into the broader economy, the Fed might have to force the economy into a recession in order to control prices. Moreover, a higher U.S. interest rate strengthens the dollar. With oil priced in dollars worldwide, a stronger dollar means a lower oil price and vice versa. That's never great for oil markets and the oil sector in general, which had been one of the standout performers this year. Yes, that's true. Oil, as the S&P 500 and the stock market in general, has fallen 25% or 22%, I believe, over the last couple of months. Oil has actually been an outlier and continued to outperform up until Friday when they had that big sell-off. So if the Fed forces a recession and with consumers beginning to feel more pain at the pump, demand destruction could set in. Yes, that's a risk. We'll talk about that later. Additionally, some large investors might be rotating out of the sector and into more recession-resistant names. Yes, we've already seen big increases in price for these oil stocks, and so people that got in early are probably locking in some of their profit. But we'll get to this later. I don't think that means that the party is over for oil stocks quite yet. In addition, China has struggled to reopen its economy under its zero-COVID policies. Although Shanghai officially reopened last week, parts of the city were put back under lockdown this week as an outbreak surfaced amid mass testing. Parts of Beijing were also shut down after a popular bar caused a super spreader event. It appears China's lockdowns could continue popping up periodically throughout the year, absent a change in policy. That could reduce demand on top of a potential economic downturn in the U.S. So yeah, we're going to have to keep an eye on what's going on in China. Obviously, if there's any lockdowns, that could reduce demand. Like this author says, I agree that that is a risk. With oil prices touching a yearly high to begin the week, it is not too surprising that stock prices are coming down, although today's decline was certainly very big and sudden. Yes, and again, that was driven by that 75 basis point Fed rate hike, and Powell also indicating at the July meeting, which will happen on the 26th or the 27th, that they're also putting 75 basis points on the table for that meeting as well. So we're going to have to keep an eye on that. Energy has been the standout sector this year, while virtually every other part of the market has plunged. Some would say this decline has been overdue in this cyclical sector, but the dynamics of the oil market are very difficult to read one way or the other right now. Yes, it's very oil stocks. The oil sector is very volatile, and you have a lot of people on the bull side and the bear side saying oil can either run higher or the bottom could fall out from under it. If inflation does happen to keep running hot, then we could see oil stocks continue to go up just based on that. Now, if we fall into a recession, everything's going to fall. I don't think you want to be a holder of oil stocks when we hit a recession and everything comes crashing down, because oil, no matter how high oil prices are, it is most likely oil will take a big hit as well. On the other hand, high prices, Fed rate hikes, and China lockdowns could destroy the strong demand we've seen this year. And while the U.S. is growing its production slowly but surely, with 7 rigs added in the last week, the OPEC plus countries are actually struggling to ramp up their supplies due to technical constraints. The supply struggles from OPEC plus could keep a floor under oil prices over the next year. So oil might not plunge as far as recession worriers might think. And yes, this is the million-dollar question. When recession fears actually materialize and we do fall into a recession, will the price of oil be able to remain elevated enough that oil takes the initial hit but is able to not fall 50, 60, 70, 80% like it historically has when the oil sector has come under pressure? Here's something else to consider. On the other hand, an end to the war in Ukraine could cause oil prices to fall further should that happen. Basically, there's a huge amount of uncertainty in the oil market right now. If you're investing in this sector, make sure to have your own long-term view on the duration of the fossil fuel industry. Also, if you have traditional energy as a fixed percentage of a diversified portfolio, try to keep it at that level and stick to your plan, selling on surges or adding on big dips when they happen in order to keep that allocation steady. An investment in fossil fuels obviously depends on a lot of different things: your risk tolerance, your time horizon, what your view is on the fossil fuel industry in general. Do you think we are going to be able to make this green transition in the next couple of years? Or do you think that fossil fuels are going to be around for decades or even potentially the next 100 years? A lot of this plays into your decision on whether you buy oil and gas stocks right now. So let's switch over and let's read the report from Credit Suisse about ExxonMobil and read their reasoning behind why they gave it a $125 price target. Here is the report courtesy of Zero Hedge. In an attempt to embrace energy transition, many global majors significantly cut back on investments in oil and gas. ExxonMobil always believed that the world will need fossil fuels for much longer, and in the medium term, demand for oil and gas will be increasing, not contracting. As a result, ExxonMobil has continued to invest in some of the most attractive oil and gas projects globally. Post-Russia-Ukraine conflict, where we are short crude, refined products, and natural gas, we expect ExxonMobil's differentiated growth strategy to deliver excellent returns for its investors. We upgrade to outperform. I agree with that investment thesis. I think the green transition, we're not ready for it. I don't think it is going to be able to take over oil and gas. I think we will be on oil and gas until at least the year 2050 before that starts coming down meaningfully and people start switching completely off of oil and gas. But let's go ahead and continue. Upstream investments. Between Guyana, Permian, Brazil, and LNG projects, ExxonMobil has an attractive lineup of upstream growth projects versus other global majors. As production ramps, ExxonMobil will see further drop in its all-in break-evens towards $35 a barrel and see material increase in free cash flow. Based on strip prices, Guyana will start generating $4.4 billion in free cash flow for ZOM by 2027, which increases to $6.4 billion by 2029. ZOM is targeting $5 billion in free cash flow from Permian in 2027, assuming Brent price of $60 a barrel. At strip, ZOM could potentially make $6.5 billion in free cash flow from Permian in 2027. ZOM is the 4th largest natural gas producer in U.S. and will also benefit from higher Henry Hub gas prices. So I like all of this. It seems like they're making smart investments on their upstream portions of their business. And let's move on a little bit further. Refining the upside surprise. While some of ZOM's peers have been selling refining assets at the bottom of the cycle at distressed valuations, ZOM has actually been investing in its refining assets. We are now in above mid-cycle margin environment, and this could last for the next 6 to 7 quarters. Refining assets will make a material positive free cash flow contribution up to $10 billion in 2022 and 2023 to ZOM and prove to be a portfolio differentiator versus peers. And then they go on to talk about the debt reduction and shareholder returns. We see ZOM lowering net debt by $17.4 billion in 2022, $8.3 billion in 2023, and $8.8 billion in 2024. At strip, we see ZOM in net cash position by 2024. ZOM current total shareholder return, $14.8 billion in dividends plus $15 billion in buybacks. Yield is 7.5%, the highest it's been in the last decade. And then let's talk really quick about valuation. Our revised $125 target price, raised from $115, is based on 8.75 times 2022 earnings. Risks, unplanned downtime and weaker chemicals and refining margins. So overall, it seems like there's quite a lot to like about ExxonMobil. And if we go over, let's look really quick at ExxonMobil. Let's go to the max chart. I always like to do this when I'm looking at a new investment. And let's see, in 2007 to 2010, during the great financial crisis, they fell 31%, which is actually in line with the S&P 500 during that time. Actually, that's less than the S&P 500 fell. I believe it was closer to 50% during that time. And then 2014 down to 2020 dropped 61% roughly. So I know that seems like big drops, but that's actually pretty good for oil and gas stocks. A lot of oil and gas stocks have lost, if you look at their max charts, have lost anywhere from 80 to 95% of their value once or twice in their history. So ZOM, actually, ExxonMobil looks like a pretty safe investment in terms of the risk of total loss of your capital. I could probably handle a 60% decline and hold on, especially because I have a much longer term view of oil and gas. I'm bullish for the longer term. Again, I don't think we're going to be switching off of oil and gas anytime soon. So I'm actually okay with that 60% drop if that were to happen. That's not ideal, but you always want to look at that in case you get stuck and you end up that it's better to hold on to an investment instead of selling at the bottom. So ExxonMobil looks like a pretty good deal. Now, if you don't want to do ExxonMobil, you can always buy XLE. This is the Energy Select Sector SPDR fund. Basically, this is the energy stocks, the oil and gas stocks from the S&P 500. And as you can see, max on this, there's been a number of drawdowns. 2008, 2009, 55%. So that's more than ExxonMobil. And then as you can see here, 71%. So actually, if we go ahead and compare these two, the index to ExxonMobil, and let's go ahead and do a max comparison, you can see here that in blue is the index and ExxonMobil is the red. So you can see a lot more volatility from the index. You're going to get, there's basically the index is made up of more volatile stocks where they're going to have higher highs. So ExxonMobil has actually a little bit lower volatility and a potentially lower return compared to the index. So that's something to keep in mind. Now, one of the other reasons that I am bullish on oil stocks in particular is that this current administration is not doing anything to alleviate the supply side problems of the oil industry. We can see here from Zero Hedge. They asked a question, so is the Biden admin doomed, and is there nothing it can do to ease gas prices? What can the Biden admin do? Well, there is one thing it could do. Only on Monday, Yellen rejected the idea that restarting the Keystone XL pipeline project would help increase supplies of oil and lower prices because it would take years to accomplish. And here's a quote from Janet Yellen. I don't see it as a short-term measure to address the current situation. And longer term, we remain committed to our climate change objectives. But it's really up to the president to consider. Biden, who campaigned on an ambitious climate platform, canceled the Keystone XL pipeline, which would run between the U.S. and Canada hours after taking office. The project was under construction when Biden revoked its presidential permit. It would have transported more than 800,000 barrels of oil a day into the U.S. So it's actions like this by the current administration that basically guarantee that oil prices will remain high. This current administration, they don't believe that oil will ever come back. They are basically saying from this point forward, we will not increase supplies. Oil is dead. Oil is done. Because of climate change, we will only embrace green technology. And so they are doing things to intentionally reduce supply, such as this Keystone XL pipeline, which Biden revoked the permit for on his first day in office. And again, 800,000 barrels. The U.S. uses about 20 million barrels a day in the U.S., so that 800,000 barrels represents about 4% of our current supply, which might not sound a lot, but at the end of the day, every little bit helps. And this is just one of many actions that this administration has done to not help lower prices by increasing the supply side of things. So short term, oil prices will remain high, and over the next 2 years, I don't think there's going to be any meaningful action by this administration to lower prices. So like they said in the Motley Fool article, oil stocks might take a hit on recession fears, but if the price stays high, we could see a rebound in oil stocks, and you might not need to sell them based on recession fears. However, that's a very risky proposition. And personally, I would be very, very careful. If oil stocks come down and start breaking through any moving averages, I would probably sell and wait for a rebound. What you really want to do here is you want to take profits when oil and gas stocks go up, and then when they come down, you can reinvest the profits. Also, if you want to buy ExxonMobil right now and hope that it goes up, that's great. But if it ends up dropping, you can also tax loss harvest that out, and you can immediately buy back something like XLE. That way you can capture the losses for your taxes, but you don't have to miss out on any of the upside. So over the short term, there's 3 different things that you guys can do. Three things. That is stay invested, well, I guess 4. Stay invested, sell and hold in cash until the market bottoms out, and then you can jump back in. Buy oil and gas stocks or other commodity stocks and hope that they outperform and that we can avoid a recession and that inflation can just naturally come down on its own. Or you can try to short the market. With all that being said, guys, I hope you learned something today, and drop a comment below and let me know what you're doing with your investments. Are you in cash? Are you dollar cost averaging into the S&P as it falls? What is your strategy? Let me know. And with that, guys, thank you so much for watching. I'll see you in the next one.